Hello, I'm Gilbert Clark. I'm the Executive Chairman of Meridian Mining. We're developing the Cabaçal copper gold project in Brazil, where we've just released our first PEA.
Gilbert, good to see you again. I saw you last week at the PDAC. How was that week for you? And I know that you put out the good news of the PEA right at the start of the week, so you probably had a better PDAC than some. But if you could give me a kind of a brief overview, that would be useful.
Yeah, no, PDAC was pretty good. As one of my shareholders said, we were the buzz of PDAC. We've long communicated to our shareholders that we had something very special in Cabaçal. We believe that the economics were incredibly robust. And by releasing the PEA that was led by Ausenco, a very quality, high quality engineering firm, we delivered the numbers that we think were in line with the potential of the project.
And obviously there was a kind of a market response. Your share price pops up kind of 15%, 20%, and big volume in the shares traded last week. Any particular commentary on the market action?
Yeah, look, we had traded over 11 million shares last week. I think people realise that the percentage of NAB now associated with Meridian is a lot of growth. We had, I guess you can say that the market was not expecting the results so early, but they came in just in time, and to have them lined up for PDAC was actually quite. It was our intent to get it out in March, but it came in earlier, and there was actually a slight delay in just doing some optimisation, but it was good for us. I think the shareholders were happy. It calmed down towards Thursday and Friday, but certainly when you look at the NPV of the project, I think we're trading at 12% of NAB, net asset value of the project now, and I think there's an incredible amount of growth yet to come out of this project within the open pit potential of Cabacal, but the greater valuation of the belt.
Well, there are two aspects there. One is how do you, well, we'll come on to this. One is how to reduce your discount to the NPV, your market capitalization is, as you, let's say, you 12% of the value of the NPV. And then the other is what is the ultimate value of the project, and again we can come on to that in terms of exploration and optimization and how the project shapes up. It almost feels, given the market was disappointed with the result of the resource publication in September, October last year, and it's almost as if the market is surprised by the quality of the asset or the NPV or what the PEA is showing in terms of the development asset here in March. So kind of over 6 months, it's gone from disappointment to surprise on the upside. You've said to me that you've had a few questions about the capex, about the operating costs. So let's go through those costs and let's explain how confident you are about those operating costs and those capital costs, because I think those are the kind of questions out there in the market at the moment.
Sure. I just in the first statement on the resource, when we did the resource, we identified straight away how up the northwest extension we had this high grade, some 3.5 million tonnes of inferred indicated, 2.5 grams of gold equivalent, and what that meant to a financial model. Because when we identified that, I was going, well, because that surface is going to pay off the capex incredibly quickly. Now we find out it's some 11 months, and when you've got that type of front end cash flow coming in at ridiculous costs in the first 5 years, your financial model is always going to be strong, because that underpins the strength of the model. And then our total capex build is $180 million US. That is pretty much in line with capital intensity. There's a few things we've been repeating, and I think people can now understand and value this, like simple things, geometry. Mineralization at surface. We don't have 1 or 2 years of pre-strip. We go straight into mineralization, and that's really a key. We used Brazilian mining metrics. We're not going to, some people want to use the big haul packs, the big 100-ton trucks. We've gone with the standard 40-ton haul packs, 40-ton trucks. So this is standard operating parameters, and we're not buying that equipment. That's with the mine fleet is not actually our cost. That's not a capex, so that comes on the OpEx. And then the final one, which is we've really been pushing, I've been telling people this time and time again, is metallurgy. Because it is so simple, metallurgy. We don't need a complicated 2 or 3 stage grinding circuit. We don't need a complicated multi-cleaning circuit for the flow sheet. We generate very quick flotation of the sulfides of the copper, gravity circuit. Only additional equipment that we put on is the dry stack tailings, the filtration plant. And we did a very detailed study on the project it finished end of last year. And even there we were able to reduce the contingency. We still had I think a 17 or an 18% increase in the cost of equipment, so the inflation was in there. But we actually did the PEA at the peak of what you say is almost peak inflation, so we expect some of these costs to come down as we come off the inflation curve.
On the recovery issues, I went through the news release on the PEA, and lots of good things. I see that there's 64% of the gold recovers in the gravity circuit. I see that the majority of the sulfides is chalcopyrite, and so you get a clean concentrate. You get a copper concentrate. A couple of questions, just out of ignorance, and I can't see the full technical report isn't filed yet, so I can't see it. So these are just ignorant questions. I read the report. I read your kind of news release, and it kind of talks about kind of getting 87% gold recovery, and yet I think in the model you're using 90% gold recovery. And it also talks about some gold being in the pyrite concentrate, but you haven't modelled the value of the pyrite concentrates. You've just valued the gold in the copper con. So I just wonder kind of how that all ties up.
Oh, okay. Well, just what we do is we actually strip out 30% of the gold through the gravity circuit. The balance goes into the copper concentrate. The pyrite surface, what goes into the tails is literally, I mean, it's nothing. We actually see a variation in gold recovery, and this comes out of the flow sheet. I think life of mine is 87, up front can be 90% for the higher grade zones. The copper concentrate is quite consistent in its recovery and also for its grade. So all these things are adding up to us, are just continual positives that go into the financial model. We don't have this dramatic drop off in recoveries with grade, and we've talked about, that's actually in one of our presentations, we talk about this, what we call the flat grade recovery curve, which is a great benefit for the project. So
even at lower grades, you still get good recoveries?
Oh, yes. Look, I think it's incredibly simple flotation. So we at 0.1% copper, I think we're already at about 90% recovery on the copper. At 0.17 grams per tonne gold, we're at like 81%. And the other thing about that, it's incredibly quick. Now, and that again, that comes into your OpEx. And if it was a very slow flotation, took a lot of time, and it might need a lot of regrinding and so forth, well, that adds to your capex. So what we do is simply, it's just a frother, some zanate. Total flotation time is about 26 minutes to get all the copper out. So from when you put the mineralization over the grizzlies into the jaw crusher, goes through the semi-autonomous grind, or the SAG mill, takes it down to 200 microns, goes into the flotation cell, goes through the rougher circuit, we regrind that at 45, makes it nice and clean, high grade concentrate, and then we start stacking the copper concentrate. That total time is only about 1 hour. So again, this impacts your OpEx and it impacts your capex, particularly on the capex, because we're not seeing a lot of recycling of the material to get that optimum recovery. And this is what drives down the capex, and this is what I'm sort of getting at. It's when you've got something so simple, so soft, I mean, its bond work index is 11 from memory, you don't need big impacts the sizing of the equipment.
Yeah, absolutely. That actually leads me on to the next question. I mean, I was a bit surprised to see a kind of a 22-year mine life. Normally, you kind of get optimum paybacks somewhere between 8 and 12 years. You know, particularly on a cash flow basis, your future on an NPV basis, your future cash flows from years 10 onwards contribute almost nothing to the value of your NPV. So on an NPV basis, we want a shorter mine life. I can see it in the optimization recommendations, but I'm just surprised that you chose that as a kind of a first approach.
Well, again, you have to look at, when you do your PEA, you've got to design what can you, a small cap junior, get financed through the conventional project finance banks. We settled on about 2.5 million tonnes. We thought it was going to cost X. It's coming quite close. That's an achievable financing. But one of the reasons that was just slight delay in publishing the PEA is we wanted to have confidence on what was the mine schedule to take it up to, say, 4 million tonnes in year 5, shorten the mine life down to 16 years. And that's what we did. So this is when we know that when we shorten the mine life through upgrading the plant in, say, year 5 to certain process something, we're going to optimise that study. It makes a big difference. But what we have to remember in all this, and this is where I think there's going to be tremendous growth in our future NPV and the NAV, is that this was based on the database that was closed off in August of last year. So all that drilling that's come in that we've published, whether it be that where we've infilled and hit more high grade like 205, or we've hit high grade mineralization in areas that were inferred, they'll move into indicated, or where we've hit areas which are actually they're not in indicated or inferred. So we're going to produce more metal into that block model, which is only going to improve the overall economics. It's the deposit of Cabaçal has tremendous upside even now in the future economics.
When we last spoke, which wasn't so long ago, you were talking about Cabaçal Northwest Extension, or is it CNWE or CEW? Cabaçal Extension North. Anyway, that bit. And is there quite a lot of that which isn't in this?
A lot of the drilling in the Northwest Extension. So we have a bias in the historical in the database to 70% of our historical drilling, and that's all vertical drilling. So that vertical drilling, everyone knows now, that vertical drilling does not define the high-grade gold overprint. So, and now what we're seeing is as we infill that areas that are dependent on the historical vertical drilling, which are creating this undercore, we can have stupendous changes in grade. I mean, 205, the highest grade interval there was some 70 grams gold within a copper gold system. In the adjacent vertical hole, 10 metres away, I think the highest grade was about 1.65 grams per tonne. So what you're going to see is more metal going to the block models. You actually have higher revenue because we're judging today's PEA, which is fantastic, on a resource that we've actually improved since then.
Okay, gotcha. And again, when we spoke a few weeks ago, you were talking about that infill program, the kind of the angle holds, the getting the drill density up to lift your average grade. So that's really what you're kind of harking back to. So the closer spaced drilling you do, the greater value per ton of the resource that you're doing. So it's interesting, isn't it? So you take the inferred resource, convert it to measured and indicated, and with it you've got this expectation based on experience that the grades are going to lift.
Absolutely, and we can see that when we compare even the historical underground drilling, which was this fan drill, and the adjacent vertical drilling from the historical times, we can see a dramatic difference there. And our QP, who did the resource, he flagged that and said, look, there is a bias towards this vertical drilling in the database, and that's why we went through that process of infilling. And I think there's a lot more to come out of this deposit. Nowhere do I think that the internal grade has been set. I see a lot of growth, and that's going to have a fantastic effect because we can further increase the shallow open pit starter pit with more grade, more tonnage. That's only going to further improve the overall economics of the project. So everyone's valuing, I guess, looking at targets, some say 30-35% of NAV. That's based on a resource that is largely improved. So there's nothing but upside.
So now it comes to how do you think that step change in valuation is going to come? Are you just going to is it a marketing exercise, or do you see that there are some kind of key milestones that you as a company need to deliver during the course of 2023? What's the plan?
Oh, look, we have to strongly market the economics of the project. There is, Merlin, I don't know about you, but I could not find a comparable. We also have to just say this is one of many deposits. It's the most advanced deposit in the belt. And we've got other like the future resource we're going to do at St. Helena. We come to drill that'll be included, and that's smaller but much higher grade. And then we have additional copper and gold projects along the belt. So it's a really interesting scenario for people when you come to this. You look, well, you've now validated something that a lot of junior companies never really do. They mine the market. What you've got is the entire belt known, defined. And they've proven the very strong economics of the key asset, which is the Cabacal open pit. So the longer term upside of this belt, it's not going to be financed out of expensive equity. It's going to be financed out of net free cash flow, because this is an ungeared financial model, and at the moment we're going to net free cash flow after 11 months, which is even more important, because under that model we can actually then do the upgrade through cash flow. It's a really interesting scenario. The value creation event that we did last week, still coming to grips with the market. Some good valid questions on the capex and the opex, but these are pretty standard parameters for Brazil.
So you feel as if you've done a pretty solid Brazilian benchmarking exercise, and the figures are low because of the lease operated on the mining for the cash costs, and the simplicity of the metallurgy, essentially reducing pipe work within the plant.
Exactly. And the other thing that we've also avoided, we've been in Brazil for a number of years now, so what we did is look for local manufacturers. And that reduces if you're going to bring in big Caterpillar trucks from America, well, you're going to pay 50% tax on top of that. So any equipment you bring in, unless you get, on a rare occasion, an exemption, you're going to pay 50-60% tax on that, which is capex. And we're building everything. We're using standard parameters. Like I said, simple things like 40-ton trucks in Brazil. They're as common as common. They're built in Brazil. So the spare parts are there. There's trained people to use them. It's a different scenario of operating in Brazil. This is why it is one of the main mining centres in the world now, because they've got cheap power, and we can go into that after. And their industry is set up to be low cost. We're not in the high cost Nordics or high cost Western Australia. We're in a low cost operating environment, and what we've been able to do is leverage our knowledge and our knowledge of our engineering firm, Ausenco, to ensure that our capex is also low cost.
I think that's a really interesting point that you raised, because if I only really understood Brazil a bit better once I lived and worked there for a couple of years. When you see Brazil from the outside, it's just another mining country. But when you're in it, because it's so geographically large, and because there's such a language barrier, so few people speak English, and so few other countries speak Portuguese, that in a sense it's kind of it's a world and a universe in itself. And because it's got this homegrown mining industry. They do everything internally. You've got consultants. You've got the full service inside Brazil. It really took me aback when I was living there how self-sufficient and how self-reliant that country is.
We've taken that to the next step. Like, aside from Adrian, our CEO, the entirety of the team is Brazilian, and for the key contracts, like the open pit modelling, the open pit costing, that was GE21, which is an established and known technical service provider in Brazil for the last couple of decades. Ausenco have got a major office there. I think they've been involved in the last 3 mine builds in Brazil. So we're dealing with real-time costings, real-time processing, real-time activity in Brazil, and that just strengthens what we're brought to the market. We didn't try to extrapolate what's the cost out the back of Western Australia or operating in the Nordics, they're actually very expensive costs. What we looked at is full taxes. So the first 10 years we're in the Sudan tax, which was a nice break for us. And then we're looking at what's the cost of labour, the cost of diesel, cost of power. I can't stress, and we've talked about this a number of times, we use, I think, 7 cents kilowatt power, hydroelectricity, sustainable renewable power. It's actually able to do contracts at 4.5 US cents a kilowatt when you go to the open market. And that's just local knowledge. So we really leveraged the company's been there since 2014, I've been there since 2018, brought the maximum amount of Brazilians into this study. So we generated what the actual costs are going to be. And this is why Brazil is such a hot M&A, because their costs are reasonable, their laws are very practical, and you can get things built, you can deploy capital and really create wealth for your shareholders.
Some of the laws are practical, some of the laws are a nightmare. Their labour law and their tax law it's a pig, but...
Oh, they're complicated.
Yeah.
They're complicated, but we have our own in-house... We have an in-house labour lawyer and management of that. So we don't. That's another thing. When we did the restructure, we kept all of that management team together, and that's why we've been so successful. We didn't create an execution team. We had that team ready to go, and now this is the benefit of those decisions that date back to 2019.
Yeah. Good. Another question for you is you only published NPV 5 and 5% discount rate for mining projects and junior mining is quite a conservative, or rather it's a low risk approach. Did you not, and particularly with your numbers looking so good, did you not think that kind of an NPV 8 was a better number to include, and what does an NPV 8 or an NPV 10 look like?
Well, we chose NPV 5 because we're using sort of what our peers were using in the small cap market. We used 5-year banking consensus on the commodity, so $3.59 for copper and $16.50 for gold. So we're nearly 200 an ounce below current spot. I mean, if we run it at say NPV 8, the IRR still stays at 58.4 on the base case. I think the IRR, the NPV goes to 443. It's still incredibly robust. I think the payback goes to like 11 and a half months. And if we use the spot price at NPV 8, I think you could go to what we used in the press release. It goes to, I think, 580 NPV at 69.7 IRR. And it's what's interesting about that is when I run these same numbers, the same rate runs spot 10%, doesn't make any difference. The real figure that I look at, which I don't actually have in front of me, is like an approximation, is when you run these things at say $13.50 gold and $3 copper, because that's where your banking finance is going to stress test it, and we still come up with 1.2 or something to NPV to capex at that very low prices. So even when you stress the model, by stressing it, when you're using really low prices, high discounts, it's incredibly robust. And when we go to do our update on our presentation, we'll put some of these numbers in there for people to compare it. But again, our numbers are robust, but this is on the database that include all the drilling since August. So there's going to be some really strong numbers come out of this going forward.
Good, thank you. No, I when I looked at the headline numbers, I saw that your commodity price choices were low, but I also saw the NPV was low, and I thought when I saw those high IRRs, 57% and 69%, is it for the other for the spot version? 70%, 69.7, 70% IRR. I mean, that's really super. So what now in terms of your technical activities for the rest of the year? We're at the end of Q1, where I see your drill rigs from your previous news release. You're drilling to the C. You're moving the drill rigs to the C2 trend. What and you're going to continue to de-risk and reconfigure and advance the Cabaçal open pit study. But can you just kind of explain how much of your drill budget is going there, and how much of your drill budget is going in exploration elsewhere, and what other kind of milestones you'll be looking at during the course of the year?
We've got one rig down at C2C, down at what we call the mine corridor. It's part of 11 kilometres of sort of upside. We've got one rig at the moment doing an infill program. There's other, in the technical advance of the project, one of the things that we have noticed in the optimisation of the open pit is, my feeling is there's still we can steepen the batters of the pit, steepen the design of the pit, which will further reduce the strip ratio. So we're doing some geotechnical work there. It's looking, when I observe the geometry of the host geology, that's very interesting for a slightly steeper pit wall, which will increase decrease the strip ratio. We're also going to do a bit of an optimization on the ultimate throughput of the pit. That's a study that we'll get Ausenco to do for us. One of the things there, that in that 2-to-1 strip ratio, we've also included approximately 30 million tonnes of sort of mineralised, low-grade mineralisation that we think what we'll do in the optimisation is move that across to end of mine. So that will actually come out of the waste rock ratio. There's also another, I'm going to reach, I think, some 27 million tonnes of unclassified material within the open pit. So we have to sort of drill out these areas that are unclassified, introduce metal, which just think it's the copper and the gold as dollars. We're going to introduce more dollars into the open pit, which will actually have quite an interesting effect, as we've discussed before, of increasing the value of the asset. We'll split on our exploration budget. We're looking at a couple of things. We'll still have one rig going across to C2C. We'll be expanding some of the, when we get the go-ahead from the authorities, we'll put some work into the Alamo deposit in the Alvaro project. They're both big copper anomalies. We've also got the ongoing project in Espigão, which I think will update the market in the coming weeks. There's a few key dates there that I'm just holding off. So we've always been a very thrifty company. I don't know about you, Merlin, but we certainly benefited from the historical database, but to do over 2 million ounce gold equivalent deposit at $3.50 an ounce, you don't get much more thrifty than that.
Is that the discovery cost? How much drilling have you done on this? Just as a kind of
gosh, we must be up to maybe approaching or past 20,000 metres now. We've done a fair bit of drilling on it. There's been a little bit in the we discovered the C2A copper, gold and silver system. We have to follow up on that eventually. But most of the drilling, I'd have to say, probably 90% of the drilling has gone into the Cabaçal deposit. It's open to the northwest. It's open down dip. It's open to the southeast. We have a lot of within I think there was 75,000 metres of historical drilling just within the Cabaçal deposit, of which there was probably 10,000 metres that we couldn't actually use in the resource calculation, just because we didn't have the downhole, or the actual drill collar coordinates. We didn't have the orientation of the drill holes, or we just didn't have the assay sheets. And we know we've published that in the past. There's some interesting areas there to be infilled. So we'll probably target some of those areas, and that could be quite prospective. So there's a balance that we're looking at. Continue to improve the very robust economics that we presented last week on the PEA, and also demonstrate, okay, we're actually now going through the process of validating a complete district, and the value on that I think is astronomical.
And what's your cash position?
We're coming up to the end of the quarter. We started the quarter at about 8.5 million in the bank. We don't tend to throw money about, so we're quite. The exact cash on hand I can't tell you, because I have to go for what the quarter is.
No, that's fine.
December 31st to 8.5.
Yeah.
Canadian.
Yeah. Good.
But we'll when it's timely, we'll look to do a capital raise sometime in the future, but I can't see one in the immediate future.
Yeah, got it. And what's your shareholder register looking like in terms of kind of institutions? What's your kind of deep pocket support you've got?
We've had a couple of meetings with our shareholders. We have our largest shareholder is a gentleman out of London. He's very happy with the results. We've had good responses from our institutional shareholders. I would have to say that we must be nudging over 50% between main shareholders, institutions, and management. And then we have a great retail investor base. They've been there with the company for a long time. We keep delivering value back to them. I think some of my retail investors that have been there since the start are becoming some of the best informed shareholders that any public company can have, because you've got to take the time to walk through and explain to them, okay, this is the scenario we have. How is it going to impact your investment? How do we grow your investment? So we do a lot of backwards and forth all the time with our shareholders.
Yeah. No, I agree. Never underestimate a determined retail shareholder for digging out information on a company.
Exactly. That's my job. I'm paid to do that. So this is the, if I've told other shareholders, if you ring up or email your CEO, your executive chairman, and they don't answer back, just sell your stock. They're not doing their job.
Good. And so what's the news flow going to look like? I mean, is it going to be kind of regular drilling updates? Is it, have you got what's your plan that you can speak to?
I think over the next couple of weeks we'll let the markets settle and let people appreciate and buy the stocks. I think we'll update on the drilling in Cabaçal, both in the open pit and perhaps also the belt scale. I think we'll look to launch and inform the market that we're going to do a short optimization study prior to going straight into the next stage, which will be a feasibility stage. There'll be an update on Espigão. That's quite key. I see a JV partner have published that they should have some results on the Araquinas tin project, which is interesting. We've got a residual holding in that.
Sorry.
But no, big constant news flow.
I'm sorry, Gilbert. Espigão. Sorry, just kind of refresh my memory, please.
Espigão was it's a IOCG project up in Rondônia, and at the moment we're doing a fairly detailed gravity survey. We're quite pleased with the initial results that we published in the market.
Good. And there was another project. So how far away is the Alvaro and the Alamo kind of set up?
They're at the extent of the belt, so they're not within what we call the core 10-kilometre radius from Cabacal. They're approximately, I'd say that Alamo is probably 12 kilometres from Cabacal, and then Alvaro is 20-25 kilometres to the south, or 20 kilometres to the south. It's all within the same belt. Look, I as we've said ever since the very start of this journey on Cabacal was such a big, the open pit was such a big bullseye, so low risk. Focus on it, and it's been very successful. The economics are fantastic. Is it the biggest deposit in the belt? I don't know. I just don't know. Alvaro is looking very interesting. Alamo is looking very interesting. It's like, as we've stated, it's doing some kilometres of conductive trends, prospective host rocks. Internally, within the mine corridor, we're finding additional anomalies. Like the Saint Helena is a 1,300 metre gold anomaly that's never been followed up, but it's been trenched and drilled. This is the validation, and at the moment we're going to get I think we're growing a revaluation on our NAV in respect to the PEA. That doesn't take into context the value of the overall belt. So when you've got something that's more than likely or potentially going to be multi-decade of net free cash flow, supporting development of the greater belt, I mean, the value of these things just don't exist today. And this is what we have to work with and communicate to the market.
Good. Well, that's why you're here. That's why you're talking to me.
Exactly.
Great. Gilbert, congratulations! Really, really great results. That PEA, some pretty special numbers. Thank you very much for giving me the update, and I look forward to seeing how you get on during the course of the year.
Absolutely, man. Thanks for the time, and as always, if anyone's got a question, just go to info@meridian.co, come straight to me, and I'll do my best to reply. Thanks again.